So I want you to imagine a company that sells literal tons of heavy metal boxes, right? They deal with these incredibly complex international shipping logistics, physical component inventories all over the globe. And somehow, and this is the crazy part, they somehow post the financial margins of a pure play, cloud-based software monopoly.
Right. Which, I mean, that just shatters the conventional wisdom of hardware economics entirely.
Totally. It feels like a glitch in the Matrix or something. That is the counterintuitive reality of what Arista Networks just pulled off.
Yeah, because traditionally, if you are building and shipping physical goods, your profit margins are just weighed down by the gravity of it all. You've got raw materials, manufacturing overhead, freight.
Yeah, the heavy lifting, literally.
Exactly. You expect those lean, gravity-defying margins like 80% gross and 30% operating profit. You expect those to belong exclusively to software companies that write code once and just distribute it digitally millions of times.
Because there's no marginal cost to sending a digital file.
Right. So seeing a physical infrastructure company operate with these kinds of software-like unit economics, it really forces us to fundamentally rethink how value is created in the modern tech stack.
And that brings us to the monumental milestone Arista Networks, ticker symbol ANET, just crossed. This is what we're breaking down in today's deep dive. We're looking at their Q2 2026 earnings report, and they just hit their first ever $3 billion quarter.
$3 billion. In a single quarter.
Yeah, that's $3 billion in revenue generated in just a 90-day period. But honestly, the sheer volume of cash isn't even the most impressive part to me.
No, it's the environment they did it in.
Exactly. They managed to pull off this level of scale while navigating what their management team described as a brutally constrained industry-wide supply chain environment.
Which is putting it mildly, honestly.
Right. I mean, while their competitors are getting on earnings calls and, crying about component shortages for missed targets, Arista's just accelerating.
The contrast is just stark. I mean, if you look back just 5 years, right?
Yeah.
Back to 2021, Arista's total revenue for the entire 12-month calendar year was $2.9 billion.
Wow. Wait, so their entire year back then was less than this single quarter?
Yep. Today, they are generating more than that every single 90 days. And that isn't just organic, slow and steady growth. That is a company riding the crest of this massive structural shift in global computing infrastructure.
Which is exactly why we're doing this deep dive today. Our mission is to dig into the hard data from this earnings call, translate the really dense Wall Street and networking jargon into actionable intelligence for you. We want to figure out whether this operational momentum makes the stock a hold, a buy, or a sell for the everyday investor.
Let's start with the headline numbers then, because the scale of the beat here tells a really compelling story.
Yeah, let's get into the data. So revenue came in at $3.01 billion. That represents a 37.7% year-over-year increase. And here's the kicker. Their own internal guidance for the quarter was $2.8 billion. So they didn't just beat Wall Street expectations, they outperformed their own internal modeling by over $200 million.
And beating your own guidance by that magnitude in a hardware business is, well, it's incredibly difficult. I mean, think about it. If a software company beats by 200 million, what do? They just provisioned a few more virtual servers.
Flipped a switch on AWS or whatever.
Right. But if a hardware company beats by 200 million, it means they have to physically procure, assemble, quality check, and ship hundreds of millions of dollars worth of extra silicon and metal that they hadn't necessarily planned for 90 days prior.
Which speaks to a supply chain that is insanely resilient and elastic.
Highly elastic, exactly.
And the bottom line growth actually outpaced the top line. Earnings per share, or EPS, came in at $1.02 per diluted share. That's a 39.7% jump from the 73 cents they reported in the same quarter last year.
That's massive.
It is. But the metric that truly demands our attention, the one that breaks that traditional hardware paradigm you were talking about, is the margin profile. They reported a gross margin of 63.4%. And on the operating income side, they generated a staggering $1.5 billion. That results in a 49.9% operating margin.
I want everyone to consider the implications of that operating margin for a second. For every dollar of revenue Arista takes in from selling these massive, complex network switches, 50 cents falls directly to the operating profit line.
Half of it.
Half. To put that in perspective, legacy hardware companies are absolutely thrilled to hit 20% or 25% operating margins. Arista's is operating at nearly double the efficiency of a traditional hardware manufacturer.
Okay, I have to challenge the mechanics of that, though, because on the surface, it just doesn't seem physically possible. If I'm buying an Arista Network switch, a huge chunk of what I'm paying for is the silicon inside, right?
Yes, the merchant silicon.
Right, the merchant silicon chips made by companies like Broadcom, which we know are not cheap. And then there's the metal chassis, the power supplies, the optical transceivers. If the raw materials themselves are so expensive, how is Arista extracting a 63% gross margin?
That's a great question.
Like, why wouldn't a startup just buy those exact same Broadcom chips, put them in a cheaper metal box, and undercut Arista on price?
Well, that is the exact thought process that actually led to Arista's creation in the first place.
Really?
Yeah. The founders, Andy Bechtolsheim, David Cheriton, and Jayshree Ullal, they realized over a decade ago that the proprietary, custom-built hardware model used by legacy giants like Cisco was a dead end.
So they went the off-the-shelf route.
Right. They decided to use standard off-the-shelf merchant silicon from Broadcom. But the secret to their margin isn't the hardware at all. The hardware is essentially a Trojan horse.
Ah, okay.
What they're actually selling, and what customers are paying this massive premium for, is the software running on that box. It's called EOS, the Extensible Operating System.
Oh, I see. So when a massive hyperscaler like Meta or Microsoft buys an Arista switch, they are treating the physical box as a commodity, but they're happily paying top dollar for the EOS software license.
Precisely. Because they are paying for network reliability that borders on the absolute. Look, in a multi-billion-dollar data center, the cost of a network switch is basically a rounding error compared to the cost of a network outage.
Right. Downtime is the ultimate enemy.
Exactly. And EOS is built on this unique architecture that separates the state of the network from the individual processes running it. So if a single process crashes, the whole switch doesn't go down.
It just isolates the crash.
Yes, and
Right.
it self-heals in milliseconds.
Yeah.
So the hyperscalers are happy to pay Arista's premium because EOS prevents catastrophic downtime, it provides deep telemetry and analytics, and it allows for massive automated network scaling.
The software provides the moat, and the software provides the margin.
You nailed it.
Okay, that explains the 63.4% gross margin. But to get to a 49.9% operating margin, you also have to keep your internal corporate expenses incredibly lean, right?
Oh, absolutely.
And the numbers from their CFO, Chantel Bright, really highlight this ruthless focus on efficiency. Their research and development spending was robust at $278.1 million, which makes sense. They're an engineering company.
Right.
But their sales and marketing expense was a microscopic 3.6% of total revenue.
Yeah, that 3.6% figure tells you literally everything you need to know about their customer base and their go-to-market strategy.
How so?
Well, they do not employ a sprawling global army of tens of thousands of sales reps taking clients out to expensive steakhouses to sell a few routers at a time.
No steak dinners for Arista.
Right. Their revenue is highly concentrated among the cloud titans, so the massive hyperscalers and tier 2 cloud providers, big financial institutions, and large enterprises. The product essentially sells itself in the engineering evaluation phase.
The engineers at Microsoft talk to the engineers at Arista, and that's the sale.
Exactly. The technical superiority of the product replaces the need for a massive sales force.
And it gets crazier. The general and administrative costs, the G&A, which is basically the corporate overhead, HR, legal, all of that, came in at just 0.8% of revenue.
Less than 1%.
Less than 1%. It is a masterclass in capital allocation. They just strip out all the corporate bloat and funnel the capital directly into engineering.
Which creates this really beautiful self-reinforcing flywheel. Low overhead allows them to maintain massive operating margins while simultaneously pouring hundreds of millions into R&D.
Which keeps the product superior.
Right, which ensures their product remains technically superior, which in turn allows them to command the premium pricing that funds the next cycle of R&D.
Incredible. Now, there was another really fascinating dynamic in the revenue breakdown. Chantel Bright highlighted a massive surge in international revenue, which hit nearly $698 million for the quarter.
That was a huge jump.
Yeah, that represents 23% of their total revenue, and that's up sharply from just 15.5% in the previous quarter. This implies the AI infrastructure build-out is no longer just a phenomenon localized to US-based tech giants in Silicon Valley or Ashburn, Virginia.
No, we are witnessing the globalization of the AI compute arms race.
So who is buying internationally?
That international spike is being driven heavily by sovereign AI initiatives. Entire countries are realizing they cannot rely solely on US-based tech companies for their foundational AI models.
Because of data privacy.
Data sovereignty, national security concerns, exactly. So you have massive infrastructure projects spinning up in the Middle East, across Europe, and in Asia.
Plus the US hyperscalers are building out there too, right?
Yes. The hyperscalers themselves are aggressively building out data centers internationally to serve those regional markets. And Arista is capturing that global geographic shift perfectly.
So the financial foundation is rock solid. We've got explosive top-line growth, peerless margins, aggressive cost control, and rapid global expansion. But, numbers on a spreadsheet only tell us what happened.
Right. We need to know the why.
Exactly. To understand if this is sustainable for you as an investor, we have to understand the underlying drivers. And the catalyst driving all of this, according to CEO Jayshree Ullal, is what she calls the AI supercycle.
Which I know the term supercycle gets thrown around really casually in tech, but in this context, it is mathematically accurate.
It's not just a buzzword this time.
No. The architecture required for AI training is fundamentally different and vastly more network intensive than the architecture that built the traditional cloud computing era over the last 15 years.
Let's break down the mechanics of that, because Jayshree spent a significant portion of the call discussing the transition from scale-out networks to scale-across networks.
This is a crucial concept.
For an investor trying to understand Arista's value proposition, grasping the difference between these two architectures is basically mandatory. So what is the physical limitation driving this shift?
Well, to understand the shift, we first have to understand what happens inside a data center when an AI model is actually being trained.
Okay, set the scene for us.
If you are training a massive, large language model, something like GPT-4 or Claude or Vaving, you cannot do it on a single computer.
Right.
You have to distribute the workload across thousands, sometimes tens of thousands, of specialized chips, typically GPUs from companies like NVIDIA.
And those GPUs can't work in isolation, obviously. They have to constantly share the results of their microcalculations with every other GPU in the cluster just to, update the weights of the neural network.
Yes, and that continuous massive exchange of data is called the all-reduce phase of training. The GPUs are essentially acting as a single, massive, synchronized supercomputer.
So they have to be perfectly in sync.
Perfect sync. If even one GPU gets delayed, waiting for data from another GPU across the network, the entire training cluster pauses.
Oh, wow.
The latency must be practically zero. For the last few years, the solution to this was scale out. You build a massive data center, you pack it with racks of GPUs, and you connect them all with an incredibly dense, ultra-fast network fabric inside that single building.
Got it. All the computing power under one roof, connected by miles of fiber optic cables running through the ceiling trays.
Yes, but the AI industry has slammed headfirst into an immovable physical barrier.
Which is?
Thermodynamics and electrical grid capacity.
The power draw.
The power draw of these new GPU clusters is astronomical. We're no longer talking about megawatts, we are talking about gigawatts.
That's hard to even conceptualize.
A single large AI data center could theoretically draw as much power as an entire mid-sized city. Or roughly the output of a nuclear reactor.
And you can't just drop a nuclear reactor's worth of power demand onto a local utility grid. The physical transmission lines would melt, assuming the power generation even existed, which it usually doesn't.
And that right there is the bottleneck. There is a profound scarcity of locations on Earth that have the available electrical capacity, the water resources for cooling, and the physical real estate required to build a single data center large enough to house the next generation of AI training clusters.
So they're out of room and out of juice.
The tech giants literally cannot put enough computers under one roof anymore.
Which forces them to decentralize. They have to go find 50 megawatts of power in Ohio, another 100 megawatts in Texas, and 75 megawatts in Virginia.
Exactly.
But they still need all of those geographically separated GPUs to function as one unified supercomputer.
And this is where we arrive at scale across. It is the architectural mandate to connect geographically isolated data centers with such extreme bandwidth and low latency that the GPUs in Texas behave as if they are sitting in the same physical rack as the GPUs in Ohio.
See, that sounds like a logistical nightmare. You are fighting the speed of light at that point. You are fighting signal degradation over hundreds of miles of fiber.
You are fighting physics itself.
Wow.
And this is the specific domain where Arista is pulling away from the competition. Jayshree noted that scaling an AI network depends heavily on a metric called radix.
Radix, let's define that for everyone.
Radix simply means the number of ports on a network switch. If a switch has low radix, say 32 ports, you can only connect 32 devices. But to connect 100,000 devices, you have to build multiple layers or tiers of switches.
And every time a packet of data has to jump from one tier of switches to the next, it encounters a toll booth, right? It adds a few microseconds of latency, it consumes more electrical power to process the hop, and it introduces another potential point of failure.
Exactly. The more tiers you have, the more inefficient the network becomes. Arista's engineering triumph, specifically with their 7800 series AI spine switches, is achieving massive, ultra-dense retics.
So they can handle way more connections on a single box.
Right. They can connect thousands of devices with fewer tiers, flattening the network architecture. This reduces latency, drastically cuts power consumption, and makes scale across technically viable.
And the financial projections for this specific capability are staggering. On the call, Jayshree highlighted that the total addressable market, the TAM for this scale across routing and switching, is forecasted to reach $15 to $20 billion by the year 2030.
It's a massive market.
Yeah.
And Antoine Gabin, an analyst from New Street Research, actually challenged her on this point during the Q&A, asking for more granularity on how Arista plays into that massive number.
What did she say?
Jayshree confirmed that by 2026, Arista expects to capture roughly $1.2 billion in scale across revenue out of a total current market size of maybe $3 to $4 billion.
Okay, so they've got a nice chunk right now.
But the trajectory is exponential. The market is going to quadruple in the next 4 years because every single hyperscaler is hitting the same physical power wall and will be forced to implement scale across architectures.
This highlights why Arista is so uniquely positioned. They aren't just selling the pipes. They are selling the specific engineering required to make a distributed AI supercomputer function over vast geographic distances.
Exactly. But, the hardware capabilities are really only half the story.
Right. The CTO, Ken Duda, took the microphone during the call and gave this really passionate breakdown of the software innovations that make this hardware usable. I want to dive into a specific feature he highlighted called SSU, or Smart System Upgrade.
SSU is arguably one of the most critical competitive moats Arista possesses. To appreciate it, you have to look at the operational reality of managing a massive network.
Which is pretty messy, usually.
Very messy. Network operating systems are incredibly complex pieces of software. And like all software, they require constant patching. Security vulnerabilities are discovered, performance optimizations are released, and bugs need to be squashed.
Right. And in a traditional IT environment, or even just on a personal laptop, installing a core system update usually requires a reboot. The system goes down, the new code loads into memory, and the system comes back up.
Yep.
But in networking, that means the switch stops passing traffic for anywhere from 2 to 10 minutes.
And in an enterprise office building, scheduling a 10-minute network outage at 2 a.m. on a Sunday is an annoyance. But, it's manageable.
Sure, nobody's in the office.
But in an AI training cluster, a 10-minute network outage is a catastrophic financial event.
Because the GPUs are just sitting there.
Yes. If you have 100,000 GPUs running at maximum capacity, costing tens of thousands of dollars per hour in electricity and depreciation, taking the network offline means all 100,000 GPUs sit idle. The training job halts.
That is painfully expensive.
Depending on the architecture, you might even corrupt the training run and have to roll back to a previous checkpoint, which could waste days of compute time.
Wow. So network administrators are faced with a terrible choice. Do we leave the network unpatched and vulnerable to security breaches, or do we patch it and incur millions of dollars in downtime costs?
Arista eliminates that choice entirely with SSU.
How does it work?
Smart System Upgrade allows a network administrator to completely swap out the underlying EOS software image and upgrade the switch to a new version without ever dropping a single packet of data.
Wait, they swap the OS while it's running?
Right, exactly. No dropped packets. The data plane, the Silicon that is actually forwarding the traffic, keeps running continuously while the control plane, which is the software managing the switch, is seamlessly upgraded in the background.
That's insane. It is the equivalent of a pit crew changing the engine on an autonomous semi-truck while it is still barreling down the highway at 80 miles per hour without the cargo ever shifting.
That is a highly accurate analogy. And the engineering required to achieve that is mind-bending. It goes back to that architecture we discussed earlier.
Where the state is separated.
Right. Because the state of the network is stored in a central database rather than in the processes themselves. Arista can restart the routing processes with new code, and those new processes instantly read the state from the database and pick up exactly where the old processes left off.
In milliseconds.
All in the span of milliseconds.
When Ken Duda explains this, it becomes incredibly obvious why a company like Microsoft will not blink at paying a premium for Arista gear. The cost of the switch, pays for itself the very first time they don't have to take the cluster offline for a security patch.
It fundamentally alters the total cost of ownership. The upfront capital expenditure might be higher than a generic white box switch, but the operational expenditure over a 5-year life cycle is drastically lower because you completely eliminate the financial penalty of downtime.
Kenduta also detailed 2 other networking protocols that Arista is pioneering for the AI era, MRC and SRv6.
Yes, these are huge.
MRC stands for Multi-Path Reliable Connection, and SRv6 is Segment Routing. Let's translate these for the listeners because they form the intelligence layer of that scale-across architecture we discussed earlier.
Let's stick with your highway analogy. In a traditional network, when a massive burst of data needs to get from point A to point B, it typically calculates the shortest path and sends all the traffic down that single route.
Makes sense on paper.
But if every device makes the same calculation, that single route becomes a massive traffic jam. Packets collide, data is dropped, and the network has to ask the sender to retransmit the data.
Which introduces massive latency. It's like a navigation app telling 10,000 cars to take the exact same exit ramp at the exact same time. The infrastructure fails.
Exactly. MRC solves this by allowing the sending switch to take that massive burst of data, drop it into thousands of pieces, and spray it across every available path in the network simultaneously.
So it uses the whole road.
It utilizes the entire highway system, the main roads, the side streets, the frontage roads.
But wait, if you chop the data up and send it down different paths that have different lengths, the packets are going to arrive at the destination entirely out of order, right?
They will, and that is the second half of the MRC protocol. The receiving switch has the intelligence to instantly catch all those out-of-order packets, sequence them correctly, and deliver them to the destination GPU perfectly reassembled.
So it maximizes the total bandwidth of the entire network fabric rather than oversaturating a single link.
Spot on.
And where does SRv6 fit into this?
SRv6 segment routing is the control mechanism for that spray. It allows the network administrators to program specific instructions directly into the headers of the data packets themselves.
Meaning what, exactly?
You are essentially giving the packet a highly detailed itinerary. You can tell a packet, take this specific fiber optic link because it has the lowest latency, but if you encounter congestion, dynamically reroute through this specific backup link.
Oh, wow. So instead of the network switches having to constantly communicate with each other to figure out where traffic should go, the packets themselves contain their own routing instructions.
Exactly. It is decentralized, autonomous traffic engineering.
That is brilliant.
And Arista integrates all of this intelligence seamlessly through their single operating system, EOS. Whether you are managing the scale-out fabric inside a single building or the scale-across routing between different states, it is the exact same software interface, the exact same command line, and the exact same telemetry data.
The operational simplicity of managing a unified ecosystem has to be a massive competitive advantage.
Huge advantage, especially over legacy vendors who have cobbled together a Frankenstein portfolio of different operating systems through various corporate acquisitions over the years.
Right. Trying to make 5 different operating systems talk to each other is a nightmare. Now, all of this software innovation and hardware architecture is incredible, but it brings us to a massive looming reality check for anyone listening.
The supply chain.
We need to talk about the supply chain. Because having the best engineering in the world is completely irrelevant if you cannot physically acquire the silicon and metal to build the boxes. And right now, the entire tech hardware sector is caught in a brutal bottleneck.
The demand for AI infrastructure has completely overwhelmed the global capacity to manufacture the underlying components.
What parts specifically are short?
We are talking about severe shortages in high-bandwidth memory chips, specialized printed circuit boards, and the advanced optical transceivers required to convert electrical signals into laser light for fiber optic transmission.
Jayshree was incredibly blunt about this on the call. She didn't sugarcoat the macro environment at all.
No, she didn't.
She stated that the industry is facing a minimum 2-year problem. She does not believe the broader supply chain tightness will be fully resolved until 2028.
Right.
But what fascinates me is how Arista is choosing to navigate this. They aren't playing defense. They are weaponizing their balance sheet.
They are executing a masterclass in aggressive supply chain management. Let's look at the raw numbers here. Last year, Arista had $3.6 billion in multi-year purchase commitments.
Okay, $3.6 billion.
By the end of Q2 2026, they had radically expanded that figure to a staggering $9.7 billion in non-cancelable purchase commitments.
They nearly tripled their financial obligations to their suppliers in a matter of months.
Yes.
$9.7 billion is a massive number. I mean, it is larger than the GDP of several small countries, entirely committed to buying raw tech components. What is the strategic endgame of locking up that much capital?
It accomplishes two vital objectives simultaneously. First, it completely de-risks their ability to hit their own revenue targets.
Because they know they have the parts.
Right. Think about it. When you are a component manufacturer, say a company fabricating printed circuit boards, and you have limited capacity, who gets priority on your production line? The mid-sized networking company ordering $50 million worth of parts, or Arista Networks, who just walked in and guaranteed you billions of dollars in revenue over the next 3 years.
Arista buys their way to the absolute front of the VIP line. They become the most important customer for every supplier in their ecosystem.
Exactly. It guarantees their allocation. But the second objective is arguably more ruthless. By cornering the market and buying up all the available future capacity, they are systematically starving their competitors of those exact same components.
Oh man, that is a phenomenal strategic insight. It is a dual-edged sword. Arista secures the materials needed to capture market share while simultaneously ensuring their competitors lack the physical inventory to fight back.
It's a supply chain moat built out of pure cash.
Todd Nightingale, Arista's chief operating officer, provided some incredible detail on how they are deploying this capital. He stated they have secured memory supply, specifically DDR4, DDR5, and NAND flash all the way into 2027.
And they didn't just lock in existing suppliers.
Plus, they are diversifying geographically to mitigate geopolitical risk, right? He mentioned they expanded to 3 different contract manufacturers and spun up 3 distinct distribution facilities located across the US, Asia, and Mexico.
Which is so smart. Because if a tariff dispute hits Asia or a localized issue disrupts manufacturing in Mexico, Arista has redundant active production lines elsewhere.
While their competitors are scaling back guidance and blaming the macro environment, Arista is utilizing their pristine balance sheet to essentially force the supply chain to bend to their will.
They are accepting the inventory risk because they understand the macroeconomic reality.
Yeah.
In a gold rush, the company that runs out of shovels loses the market forever.
There was one specific supply chain initiative Todd mentioned that initially caught me completely off guard.
The liquid cooling.
Yes. He talked about establishing a brand new, massive supply chain dedicated entirely to liquid cooling. He specifically called out vendors for cold plates, quick disconnects, and specialized plumbing tubing.
Yeah.
Why is a networking company suddenly in the business of advanced plumbing?
It is entirely driven by the thermodynamics of the next generation of silicon. Historically, network switches were cooled by massive fans pushing high-velocity air over metal heat sinks attached to the chips.
Which is loud, but it works.
It worked. But as Arista pushes into the next frontier of networking, specifically, their new 1.6 terabit class of switches air cooling simply fails to obey the laws of physics required to keep the box from melting.
See, I can understand why an NVIDIA GPU processing trillions of AI calculations needs liquid cooling, but a network switch is ultimately just routing data. Why is a switch generating so much heat that it requires a water jacket?
It comes down to the physics of moving data at 1.6 terabits per second. To achieve that throughput, you have to use advanced optical transceivers. These transceivers take the electrical signals generated by the networking silicon and convert them into pulses of light to travel over fiber optic cables. The process of serialization and deserialization, converting the electrical data stream into high-frequency optical signals and back again, it requires an enormous amount of electrical power at those extreme speeds.
And wherever you have massive electrical power consumption concentrated on a tiny piece of silicon,
You have massive heat generation.
Yeah.
Precisely. The heat density of the new 1.6T optics, combined with the core routing ASIC itself, produces thermal loads that air cannot physically carry away fast enough.
So you have to use liquid.
You must introduce chilled liquid directly to the components via cold plates to transfer the heat out of the system.
Honestly, mixing highly conductive chilled liquid with multi-million-dollar networking electronics is a terrifying prospect from a reliability standpoint. If a quick disconnect fitting leaks inside a data center rack, it's catastrophic.
Which is exactly why Arista is building the supply chain now, years in advance of mass deployment.
Getting ahead of the curve.
Jayshree noted that while trials for the new 1.6T switches, like their 7060XE7, which boasts 100 terabit capacity, will begin in the second half of this year, the true production scale won't happen until 2027.
Why the delay? Is it the switch technology?
No, the delay is on the customer side. The hyperscalers literally have to retrofit their data centers to support liquid plumbing to the network racks.
Because they only have plumbing for the compute racks right now.
Right. Arista is engineering the liquid cooling supply chain today so that when the data centers are finally plumbed and ready in 2027, Arista has a fully mature, leak-tested, mass-producible liquid cooling ecosystem ready to ship.
It is forward-looking operational execution at its finest.
It really is.
So all of this operational dominance, the $9.7 billion supply chain flex, the liquid cooling preparations, the software moats, it culminates in the most explosive part of this earnings call, the management guidance.
The guidance was incredible.
If the Q2 numbers were impressive, the forward-looking projections were a definitive mic drop.
Because guidance is where management signals their true confidence. I mean, a company might have a lucky quarter due to a deferred revenue recognition or a one-time order, but when management aggressively raises their forward guidance, they're staking their reputation on a sustained acceleration in underlying demand.
And Arista's management didn't just raise guidance, they raised it for the third consecutive time this calendar year.
Third time.
Let's map out this trajectory because it is stunning. Coming into the year, their stated goal at their Analyst Day was to hit $10.5 billion in full-year revenue for 2026.
Okay.
By May, they saw demand accelerating and bumped that target to $11.5 billion. Now, just 3 months later on this Q2 call, they have hiked it again, adding another $1.1 billion to reach a new full-year target of $12.6 billion.
A $12.6 billion target equates to roughly 40% annual growth. To understand the scale of that, you have to realize that by raising the target from $11.5 billion to $12.6 billion in a single quarter, they essentially added $1.1 billion in incremental new growth.
Just tacked it on.
That incremental addition is equal to a third of their entire annual revenue from just 5 years ago.
That's just nuts. And for Q3 specifically, they are forecasting roughly $3.3 billion in revenue, and they raised their operating margin target range for the full year to an incredible 48% to 49%.
But the most crucial insight for investors is uncovering exactly where this massive $1.1 billion raise is actually coming from.
Right, because the assumption for most casual observers is that it must be 100% driven by the AI hype cycle.
That is the natural assumption, but it is entirely incorrect. And uncovering that truth is where the real alpha lies for an investor analyzing this stock.
Break it down for us.
During the call, CFO Chantel Bright reaffirmed their specific target segments. They're projecting at least $3.5 billion in revenue to come specifically from AI-related deployments.
Okay.
And at least $1.25 billion to come from their campus networking business.
Wait, Simon Leopold, an analyst from Raymond James, caught that discrepancy immediately, right?
Yes, he did.
He asked the obvious question. If you are keeping your AI target locked at $3.5 billion and your campus target locked at $1.25 billion, what is generating this massive new $1.1 billion raise? Where is the hidden growth engine?
And Jayshree's answer was arguably the most bullish indicator of the entire call. She clarified that the $1.1 billion raise is being driven by broad-based strength across their traditional core business lines.
The legacy stuff.
Yes, it is the enterprise sector. It is the traditional data center front-end networks. It is the high-speed routing business.
She specifically shouted out the enterprise and routing teams for having record-breaking quarters. This completely dismantles the bear argument that Arista is just a one-trick pony riding an AI bubble that might eventually pop.
It proves that the demand for high-performance networking is systemic. Yes, AI is the hypergrowth catalyst, absolutely. But traditional Fortune 500 enterprises, financial institutions, and Tier 2 cloud providers are all undergoing massive digital transformations that require Arista's core infrastructure.
Their bread and butter business is not just stable, it is aggressively reaccelerating.
Exactly.
But I have to play the skeptic here regarding this massive guidance.
Okay, lay it on me.
We just spent 20 minutes discussing how the global supply chain is fundamentally broken and severely constrained until 2028. Given that macroeconomic reality isn't guiding for 40% growth and $12.6 billion incredibly dangerous.
In what way?
Like if a single major supplier defaults or delays a shipment, they miss that massive target, and Wall Street will punish the stock mercilessly.
That risk profile would apply to almost any other hardware company, but you have to connect the guidance directly back to the $9.7 billion in purchase commitments we analyzed earlier.
Ah, the war chest.
Right. Arista is not projecting $12.6 billion based on theoretical demand they hope they can fulfill. They are guiding high, precisely because they have already secured the physical materials to build $12.6 billion worth of product.
The guidance isn't a hope, it's a math equation based on secured inventory.
Exactly. When David Vogt from UBS asked about their visibility into the back half of the year, Chantel Bright essentially stated that their guidance is constrained by supply, not demand.
The demand is even higher.
The demand from customers far exceeds $12.6 billion. They are guiding to $12.6 billion because that is the exact amount of supply they have absolute confidence they can squeeze out of their contract manufacturers.
She even left the door open for upside, hinting that if the supply chain bottlenecks loosen even fractionally faster than anticipated, they have the immediate customer demand ready to absorb the extra product and blow past the $12.6 billion mark.
And that explains why they intentionally didn't raise the specific $3.5 billion AI target.
Yeah.
Jayshree noted that the AI number will likely climb, but she specifically chose to leave the $1.1 billion raise unallocated in their public targets.
Why?
The strategic rationale is brilliant. She wants to give her chief operating officer, Todd Nightingale, the absolute operational flexibility to ship whatever products he can manufacture the fastest.
Oh, so if the components for a traditional enterprise router arrive at the factory before the components for a liquid-cooled AI switch, build and ship the enterprise router.
Right. Don't hold up revenue waiting for AI parts just to hit an arbitrary Wall Street sub-target.
It is the ultimate pragmatic approach to running a supply-constrained business, optimize for total throughput and total cash flow, rather than optimizing for a specific narrative.
Exactly.
Speaking of cash flow, that brings us to the bottom line of this deep dive. Our goal is to translate all of this data, the thermodynamics, the software moats, and the supply chain dominance into actionable, opinionated advice for the retail investor listening right now. What is the definitive verdict on Arista Networks?
The verdict is unequivocally bullish. We are looking at a company executing with near-perfect precision in the single most critical, capital-intensive sector of the global economy, the build-out of artificial intelligence infrastructure.
Let's synthesize the pillars of that bullish thesis. First, the technological moat is widening. Their EOS software and innovations like SSU provide operational efficiencies that cheaper competitors simply cannot replicate, which locks in their massive margins.
Right. Second, their operational execution is unparalleled. They are weaponizing a massive $9.7 billion war chest to secure their supply chain and choke out competitors.
And third, the financial engine is pristine. They generated $1.1 billion in pure cash flow from operations in this quarter alone.
They are sitting on a fortress balance sheet with over $13.3 billion in cash equivalents, and marketable securities. They have virtually zero net debt, and they have an active $817 million share repurchase program to support the stock price.
So if you're an investor currently holding ANET stock, the actionable advice is incredibly clear. This earnings report is a textbook validation of the thesis. Do not try to get cute and time the market by selling a company that is raising guidance for the third time in 6 months while maintaining 50% operating margins.
And for the investor on the sidelines considering initiating a position, you really have to look at Arista through the lens of a broader AI portfolio strategy.
How so?
Right now, there is a brutal capital-destroying war happening at the software layer. OpenAI, Google, Anthropic, Meta, they are all burning tens of billions of dollars trying to build the ultimate foundational AI model. As an investor, picking the winner of that software war is a massive gamble.
It is a bloodbath. If you bet on Google and OpenAI releases a model that makes them obsolete tomorrow, your investment is destroyed.
But you don't have to play that game. You don't have to bet on which AI model wins the race. You only have to bet that the race will continue and that every single participant in that race is going to spend billions of dollars on the infrastructure required to compete.
And Arista is the infrastructure.
Arista is the infrastructure.
It is the classic infrastructure play, but let's avoid the tired picks and shovels in a gold rush cliche. Arista is building the physical highway system and the toll booths for a massive fleet of autonomous AI trucks.
I love that analogy.
It does not matter to Arista whether the Google truck or the OpenAI truck wins the race. Every single truck has to drive on their highway, and every single truck has to pay their toll.
That is the perfect framework. You are investing in the toll road of the AI economy.
Before we wrap up, I want to leave our listeners with one final provocative thought to chew on a dynamic from the Q&A section of the call that points toward the next massive battleground in the tech sector.
This is the NVIDIA piece.
Right. Right now, NVIDIA is the undisputed king of AI hardware. They build the GPUs, but they also have their own proprietary networking technology called NVLink.
And NVLink is a formidable technology. NVIDIA uses it to create a tightly integrated proprietary ecosystem. a walled garden.
A closed loop.
Right. When a hyperscaler buys a full NVIDIA server rack, the GPUs communicate with each other internally using NVLink. In those specific scale-up scenarios inside the rack, Arista's Ethernet technology is largely shut out.
Jayshree was completely transparent about this reality. She flat out said, we live in an NVIDIA world.
Which is very honest.
Yeah. Arista dominates the scale-out and scale-across networking that connects the broader data centers together, but they are currently locked out of that inner circle inside the NVIDIA server rack.
But the provocative nugget is how Arista is positioning itself for the inevitable rebellion against that walled garden.
The rebellion.
The entire tech industry hates being locked into a single vendor's proprietary standard, especially when that vendor exercises monopoly pricing power. Jayshree expressed immense enthusiasm for the rapid rise of non-NVIDIA AI accelerators.
She specifically called out the competitive landscape. AMD's MI series chips, Google's custom TPUs, and the massive wave of in-house custom silicon being developed by Microsoft, Meta, and Amazon.
And what all of those non-NVIDIA competitors have in common is that they are not using NVLink. They are relying on open Ethernet standards to connect their chips. They have formed a massive alliance called the Ultra Ethernet Consortium. Their goal is to break NVIDIA's proprietary grip by ensuring that AI hardware from any vendor can seamlessly interoperate using standard Ethernet protocols.
And in a world governed by open Ethernet standards, Arista Networks is the undisputed heavyweight champion.
Exactly.
Jayshree drew a fascinating historical parallel on this. She pointed out that a few years ago, everyone assumed a proprietary technology called InfiniBand was the only way to do high-performance computing.
Right, everyone thought InfiniBand was unbeatable.
But Ethernet eventually evolved, adapted, and crushed InfiniBand because open, interoperable standards almost always win out over closed proprietary systems over a long enough timeline.
She is betting the future of the company that the exact same historical cycle will play out against NVLink.
This leaves us with the ultimate multi-billion-dollar question for you, the investor, to ponder. Will the future of global AI infrastructure remain a closed, proprietary walled garden owned entirely by one massive chipmaker?
Or will the sheer scale, cost, and complexity of AI force the market to break open into an interoperable ecosystem?
Right, a world where open Ethernet standards dominate and Arista's networking technology becomes the universal nervous system of the AI age.
If you believe in the eventual triumph of open standards, then Arista's current milestone of a $3 billion quarter isn't the peak of their trajectory. It is merely the opening chapter of a much larger story.
We started this deep dive exploring how a physical hardware company could somehow emulate the financial physics of a software monopoly. What we uncovered is a masterclass in strategic decoupling, operational ruthlessness, and visionary engineering.
They use merchant silicon as the foundation, EOS software as the impenetrable moat, and a $9.7 billion supply chain war chest as the battering ram.
It is a rare privilege to analyze a company executing at this level of precision during a generational shift in technology. They aren't just participating in the AI supercycle, they are actively dictating the terms of its physical expansion.
Well said.
Thank you for joining us on this deep dive. We hope this breakdown pierced through the jargon, laid out the hard data, and provided the actionable clarity you need to navigate this incredibly complex market. Keep challenging the consensus, keep digging into the financials, and we will see you on the next deep dive.